Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 17th, 2026. How you doing? I hope you had a good trading week. I hope you're having a nice weekend, and I appreciate you coming to my weekend review podcast. I hope you are going to find it helpful and you're going to learn something today. Let me just quickly go over what the format of the podcast is going to be. So first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to look at all the trades and the positions that I had anything to do with last week. We are going to talk about when I entered the trades, why I entered the trades, what the confluences of signals were when of why I entered the trade, how I placed my emergency stop, how I placed my end of bar stop, how I take partial profits if the market heads my way, what I do when I get into trailing stop mode, and then ultimately how I am going to exit the position. So like I said, I hope this is going to be helpful for you to get an idea of how I look at trading, entering the trades, and managing the trades. I had some really good trades. I got stopped out of some trades last week. You can feel the market's changing a little bit, but overall, it was a good week, and I'm going to share these trades with you. After that, we're going to talk a little bit about trader psychology. Most important skill in the world in trading is the ability to create a plan and to follow it. It doesn't have to be a complicated plan, very simple plan, but the key is really when it comes down to getting into positions, being patient, waiting for a confluence of signals, having good risk to reward ratio, position sizing correctly, but more importantly, following your plan to keep those risks low and potential upsides big. But you can have the best plan in the world, but if you don't follow it, it doesn't do any good. So I always like to spend a few minutes on trader psychology. Always helps me to teach it, and so I hope it's going to be helpful for you as well. After that, every Friday night I go down through my master watch list. I go down through each one by one, and I look for potential upcoming trades for the next week. And really, what I'm looking for confluences of signals that are they're not there now, right? Because if they were, I would have already considered taking the trade, but close. They're within striking distance, and I'm looking for combinations of order blocks, major moving averages, RSI levels, double bottoms, bullish MACD divergences, and ideally, the best trades are the ones that involve all of these kind of lining up. It's like the stars kind of lining up for levels of support. So I have 13 of them that I'm going to go through at the end of the podcast, and I'll break down what I'm looking for and what needs to happen in order for me to get into the trade. So like I said, I hope you're going to find this helpful. If you do, I really would appreciate if you could hit the thumbs up button. Really helps out the channel more than you know. And this way YouTube knows that there's some kind of value in the video and helps share it with more people. So uh, uh, let's get this U.S. legal disclaimer out of the way, and then we'll come back and we'll get started.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding that through that with me, and let's get started on the current positions, the current open daily positions that I have. First on board is Shopify. So I entered Shopify on the 18th of November at $140.47. So why did I take this trade? You see this green block here. This is called an order block, or another word that I like to use for this is a smart money indicator. So I entered here 140.47, but let me take you back and explain why the order block formed in the first place. So the order block formed back here on the 2nd of September. So let me explain what an order block is, the way that I use them. People have different interpretations of order blocks. Some of them are very complicated. I try to make it simple because simple is just better, but this is what I use and it works quite well for me. So the order block the order block is here on the 2nd of September, but why is it on the 2nd of September? The, the pattern that I use for an order block is first I need a swing low. A swing low is a low that has a higher low to the left and it has a higher low to the right. So this is a swing low. After that first swing low, I need a swing high, which is just the opposite, a lower high to the left and a lower high to the right. So you can see this is a swing low because we have a lower high to the left and a lower high to the right. And then the very next bar becomes a swing high, lower high to the left, lower high to the right. So we have a swing low and we have a swing high. After that first swing high, in the future, we need another swing low. This is a swing low, right? Because the low to the left is higher, the low to the right is higher. So we have a swing low followed by a swing high, followed by another swing low. And the important thing to remember here is that the second swing low has to be lower than the first swing low. So swing low, swing high, lower swing low. Now, when this is in place, we have to look back and key at that first swing high. If in the future this particular market goes above the swing high like it did here, now we have changed market structure to the upside. So let's just review. Swing low, followed by a swing high, followed by another swing low that's lower than the first swing low, and then price moves above this swing high. As soon as this happens, now the lowest closing bar, which is here, prior to the market structure change going above the first swing high, becomes the order block. So swing low, swing high, lower swing low, market structure change because we take out that swing high. And as soon as that happens, I just look to the left for my lowest closing bar. That is my order block. This bar, the high and the low of this bar moving into the future is now my order block. Now, I don't buy these breakouts, although this one would have been just fantastic. I wait for the price to come back to that original smart money area. So so we know market structure changed here, and uh, this is the order block. Well, when we go into the future, look when Shopify was way up here at $181. In hindsight, can you look back at that order block and is it fair to say smart money was buying there? Well, sure. In hindsight, right? Because you can tell clearly smart money was buying here in the future when it's this high. Okay. So I can go, okay, this was smart money. So really what I'm waiting for is I'm waiting for the price to come back into the smart money area. Now, it was smart money before. Does it mean 100% of the time it's going to be smart money again? No, because things can change. But in my experience, my 30 plus years of trading, the smart money area in the past is more likely to be smart money in the future. And you can see we have the swing low, we have the swing high, we have the slower swing low, we break market structure change, and then we do take off. We did have a little bit of a pullback. Where did it pull back to? It pulled back to the smart money area before it took off again. Now, I didn't take this trade, but I am just keying off of this smart money area, bringing it into the future. I'm not going to do anything with it unless it comes back into the smart money area. Well, that's exactly what it did when I entered the trade. You can see I entered the trade here at 140.47 when it rejected the high of the order block, meaning it went in the order block, but then it closed above it, and that means a rejection of the high. So on order blocks, basically I have three different ways to get in. I can get in with the rejection of the high of the order block, I can get in with the rejection of the low of the order block, or I can get in with a rejection somewhere in the order block if it's a midpoint and I'll explain those later, a major moving average that lives inside the order block. Okay, but this one was just simply a rejection of the high of the order block. So like I said, I entered here with the rejection of the high of the order block at $140.47. Now, as soon as I've entered the trade, first thing I have to decide is how many shares am I going to buy? Okay, probably the most important decision you'll make in trading always is how many shares you're going to buy. And let me show you the formula that I use. It's very simple and it's really good because it takes into account how much I have in my trading account and what the volatility of the market is. So the first thing, let's just assume I have $100,000 in my trading account. All I do is take 1% of that. And if you have $200,000, it's 1% of 200,000. If you have a million, it's 1% of that of a million, right? But let's just say I have $100,000. 1% of that is $1,000. Very simple. All I do after I do my 1%, I look to the value of the 2 ATR. Right now it's 1401. And ATR means average true range. This is what this particular market is expected to move in any one day. I take that value times it by 2, okay? And that's how I figure my position size. That's how I place my emergency stop. So 1% of my total capital, $100,000 times 1% is 1,000 divided by the value of the 2 ATR divided by 1401 tells me to buy 71.37 shares. So I'll just round it down to 71 shares. Okay, so entered on the 18th of November at 140.47 with 73 shares, right? Boom, simple. Next thing I do is I take my entry price minus the value of the 2 ATR, which is 1401. So I take my entry price minus 1401. I put my emergency stop. Because if I have 73 shares and it moves down $14.01, how much have I lost? $1,000, right? Because I already did the math. This is my worst case scenario essentially on this trade. Basically what I'm saying is the maximum I am willing to lose in my total trading account on this particular trade is 1%. And that's how we did the math. So I place my emergency stop here. And if it gets down there and touches it, whatever time of the day, I'm out because I know I've lost 1% of my account. But the good news is that this only happens, your emergency stop only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it will not be my emergency stop. It will be my end of bar stop. And my end of bar stop will always be closer to my entry price than the emergency stop. So what does that mean? That means if I lose, I'm going to lose less than the 1%. The 1%, the emergency stop, only 5% of the time in my experience. So where is my end of bar stop on this trade? My end of bar stop on this particular trade, it's different on whatever strategy I'm trading, but on this one, it's a close below the low of the order block. Okay, I got in because it rejected the high of the order block, but my end of bar stop, if the very next day it closed just the penny below this order block, I would have gotten out. And I have some trades that I'm going to show you in a little while. Exactly this thing happened and I had to get out. Okay, so rejection of the order block that was formed in the past, entered 140.47, position size correctly, placed my emergency stop 2 ATRs below my end of bar stop, close below the order block. Next thing I do is I find the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $10.51. I take my entry price plus whatever the value is on that particular day, and I place an orange line above. This is called my trailing stop level. If I take the trade and it starts moving my way in the future, if it ever touches, it doesn't have to close or anything like that. It just has to, at one point during the day, anytime, touch that orange line. That means the price has moved 1.5 ATRs above my entry. Now I'm in trailing stop mode. And in trading, when you get into a trade and it starts moving your way a certain distance, then you want to tighten everything up. You don't want to give it all back, right? You want to tighten up your stops. And I do that in two different ways, but let's concentrate here first on the trailing stop mode. So once I get into trailing stop mode, it doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I will exit half of the remaining shares that I have at the moment. And by doing that, that moves up my stops, everything by half, right? Because I've taken half off. So it improves my trailing stop level by 50%. Okay? Okay, so everything I've talked about so far, as far as emergency stops, end of bar stops, going into trailing stop mode, these are all defensive moves. So in other words, if the price moves against me, if it does something I don't like and I have to take action, I have to take defensive action. But like in sports, it's great to have a good defense, but you also have to have an offense on your team. And the offensive part of my trading, which I'll explain right now, has to do with taking partial profits if the price moves a certain amount in my favor from the previous bar's close. Okay, so I'm currently still in this trade. Let me show you exactly how I'm going to do this for Tuesday, because Monday the market's closed for Martin Luther King Day. So again, I'm going to take partial profits every day if it moves a certain direction in my favor above the previous bar's close. So right now, Shopify, the previous bar's close is 155.81. So I take 155.81, and now I look for the value of the 0.45 ATR. The 0.45 ATR is $2.65. So all I do is take the closing price, 155, and I do this every day. It's going to change every day. But for Tuesday, 155.81 plus $2.65. My first profit target for Tuesday is going to be $158.46. That's my first profit target here, 158.46. Let's just put a line here. 158, 158.46. There's my first profit target for Monday. If it gets there, how much do I take off? Simple. 10% of however many shares I'm going into the day with. If I'm going into the day with 50 shares, 5 shares. That's it. Okay. Now, I place 3 profit targets every day. So I just showed you how to place the first profit target. Closing price plus 0.4. The value of the 0.45 ATR is 265. My first limit order for the day is 158.46. But I do it again. I just take the first profit target, 158.46, add to it again the value of the 0.45 ATR. My second profit target for Monday is 161.11. So we'll just put a line there. 161.11. Boom. There's my second profit target. And I also, assuming I'm going into the day with 50 shares, put another profit there for 5 shares. So 5 and 5. And I do it one more time. I take the second profit target, 161.11, plus $2.65. My third profit target for the day, 163.76. 163.76. So those are my 3 profit targets for Monday. If I'm going into Tuesday, if I'm going into Tuesday with 50 shares, 10%, 10%, 10%, 5 here, 5 here, 5 here. If the market goes down on Monday or Tuesday, I'm not going to hit any and I'll have to redo it. If the market goes up on Tuesday and I have a decent day, maybe I hit 1, take 1 off. Or if I have a great day, maybe I hit 2, take those off. But taking partial profits to me is extremely important. And I'll show you in the rest of the trades that I'm going to show you today how important it is. And, every day that you hit a profit target, you are reducing your position size, you're reducing your overall risk. And when you think about it, you are tightening up your stop every single day by taking more and more off. So you're consistently tightening up your stop on the trade, which is important, right? So Okay, so that's how I take partial profit. So now let's just kind of look at the trade going as the new trade. Now that I've kind of given you some of the basics. So okay, here we go. November 18th, I got in $140.47. Why? Because of rejection of the previous order block. I position size, I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. When I entered, I placed my trailing stop level 1.5 ATRs above, and let's just follow the trade and see what happens. After I took the trade, the very next day went up enough for a profit target. Great. Took a little off, locked that in, tighten up my stop just by doing that. Okay. The next day it gaps up really high. I hit multiple profit targets. I think I hit 2 profit targets on this particular day, right at the open. Boom. Again, tightening up the trade even more by taking those off. In addition to those 2 profit targets at the open, I also got to trailing stop levels. Again, it doesn't mean I do anything. It just means now in the future, if I have a close below the previous bar's low, I'm going to get out of half. So opened up here, hit the profit targets in profit in trailing stop mode, reversed. So I was really glad that I took some two profit targets off there at the top, right? Next day goes up and again, great, profit target. Next day goes up again, profit target into that strength. Next day goes up a little bit more, not enough for a profit target, and then 2 days of kind of nothing. And then here on the 1st of December, we have our first close below a previous bar's low after reaching trailing stop level. I take off half of the remaining, half of the shares that I went into the day with, okay? So first close below previous bar's low after trailing stop level. The remaining shares I had at that moment, I took half of them off, locked in a gain of 5.72%. Okay. But taking off half is one of the best things you can do in trading. It's one of the only win-win situations in trading. Because if I take half off and it goes down, I'm glad I took half off. If I took off half and it goes up, I'm still glad I have half. Make sense? Okay, so the very next day rallies right back up. Profit target next day up a little bit, not really anything. Did get a profit target on this big bar. Again, selling into the strength when the market gives it to me. And by default, it's tightening up my stop on this trade more and more. Then a couple down days, and then we have a nice up bar here where I took profits into there, I took profits into there. Nothing much happening here. We started to go down. And so at this point, this is a very easy trade because as long as it stays above my stop, whenever I have big days up, I sell into the strength like here, and it just keeps reducing my profit target. Or it keeps reducing my position size and keeps locking in those profits. Now, there's a certain point to where I'm going to exit the trade, and that usually happens when the RSI gets to 65 RSI. This particular trade never got to 65 RSI, so that's why I'm still in. So going forward, I'm going to keep taking profits if it goes up. If it heads back down, there's really nothing much I can do. And if it closes below the low of that order block, I will get out. If it heads up enough to get to a 65 RSI level, now the 5 EMA comes into play. And I have multiple examples of that to show you later in the trade. But anyway, this has been a good trade. And the remaining shares that I have on this particular trade at the moment are up 9.97%. And again, just a simple rejection of the high of the order block is why I entered the trade in the first place. Home Depot. Okay, Home Depot is another order block trade. And the order block for me was here on the 9th of December. Why? Because here we have a swing low, we have a swing high, we have a lower swing low. This bar here takes out the first swing high, creates changes the market structure to a bullish market structure, and also defines the order block. Again, the way that I use order blocks, the high and the low, the lowest closing bar right before market structure happened, I bring this into the future. Okay, we head right back down into the order block. I took the trade here on the 6th of January at 394.23 when it closed back in the order block. So I enter here 349.23. I position size correctly like I showed you. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below this green box. Any close below the green box of this order block, I am out of the trade. Okay. I place my 1.5 ATR trailing stop level above, and away we go. The next day, thankfully, move my direction quickly, hit 2 profit targets right off of the bat. Again, taking those partial profits just has the effect of tightening up your stop just naturally, right? Because you're taking it off. The very next day goes up again nicely, hit multiple profit targets, and I touch trailing stop. So now I'm in trailing stop mode. Next day takes off again, multiple profit targets, which is fantastic. And then we kind of move sideways, no profit targets. And then this bar goes up here. That was a profit target. Now, I took off half of the position on Friday. Why? Look at the RSI. The RSI is 68.87. Okay. You can see we did not close at the high of the day. It was higher earlier in the day. At the high of this day, intraday on Friday, Home Depot got above 70 RSI, but then it closed below the 70 RSI. That is a rejection of the 70 RSI. Whenever I have a rejection of the 70 RSI, I sell half of my shares, the remaining shares that I have. It's just a rule that I've used for many, many years because 70 RSI is an overbought level. 92% of the time when you get up to the 70 RSI, generally that's it, you have a pullback. So if I'm long, that tells me, statistically, this is probably a place to take some off. Not all, just half. So I did take off half of the position on a Friday with the rejection of the 70 RSI and locked in a gain of 8.14%. Now, going forward, if it continues up, of course, I'll just continue to sell partial profits into that. However, if I ever get to a 65 RSI level or higher, which it's at right now, in the future, if I close below the 5 EMA, this is the thin blue line, I exit the trade. Alternatively, if I reject the 70 RSI like I did on Friday, and then we have a close below a previous bar's low, I'm also going to get out of the remainder of the trade. So going forward, it's pretty simple. If I have a close below a previous bar's low, that's it. If I close below the 5 EMA, that's it. I'm out. I'm done with the trade. But I leave the door open to the upside. If it continues to go up, I'll continue to take partial profits into the strength. So this has been a really nice trade. Good example of the order block here. Remaining shares I have up locked in half at 8.14%. Coca-Cola. All right. We have an order block on Coca-Cola from the past. Let's go back and find it. Here it is, right here. Why? Swing low, swing high, lower swing low. This bar here changes market structure because it took out the swing high. It also defines my order block. Lowest closing bar prior to market structure change, the high and the low of that comes into the future. You can see when the market was up here and you look back with smart money buying there, well, sure, because it's much higher here than it was back here. But this is my smart money area. I'm waiting for price to come back. It finally did. I entered Coca-Cola here on the 7th at $67.53. Why? Greg, it didn't reject the high of the order block. It didn't reject the bottom of the order block. And there are no moving averages in here. Why did I take it here? Simply because during the day, it went under the 30 RSI. Now, you're not seeing the 30 RSI in here, so not as many people see it, but look here at the close of the day. The RSI was 3107. Okay, 3107. Did it close at its low? No, it did not. It was lower than 30 during the day, but it was able to recover by the end of the day back over 30. So that was my signal. Intraday rejection of the 30 RSI inside the order block. So when I have major moving averages, when I have other midpoints, or I have RSI rejections inside the order block, it's a key level within a key level. The order block itself is a key level, and then a rejection of a major moving average is a key level, a rejection of RSI is a key level, a rejection of another level that I put in, and I'll show you that in the future. So I entered here, rejection of the 30 RSI inside the order block, key level within key level. I entered at 67.53. I position size as always. My emergency stop, 2 ATRs below. My end bar stop, well, I took this trade because it went under 30 and back over 30. So in the if I would have taken this trade and the next day it would have closed back under 30, I simply would have been out, right? My risk to reward ratio was good because it closed at 31.07 or whatever it was. Next day, if it closes at 29.99, I simply get out, right? So there we go. Entered at 67.53. My emergency stops 2 ATRs below. My end of bar stop is a close below 30 RSI. I placed my 1.5 ATR trailing stop level above. Next day takes off like a rocket ship. Hit multiple profit targets. I think I hit 3 profit targets, maybe 4. I can't remember now. So sold into that strength. That's the offensive part. Also got to trailing stop level. Next day takes off again. Multiple profit targets. Reducing my position size into the strength. Tightening up my stop by default into the strength. Next day gaps up a little bit. Closes back below. Next day up again, which is fantastic. Sold some more into that strength. And then here on the 15th was my first close below a previous bar's low. After reaching trailing stop level, what do? I take off half my position for a gain of 4.19%. Now, we didn't reach 65 RSI level, so the 5 EMA is not in play. And so going forward, if I'll continue to take partial profits if it moves my direction. If it does get to a 65 RSI, the 5 EMA will come into play. If I get up into the 70s and reject it, I'm going to sell half there as well. Or if it heads back down and closes under the 30 RSI, well, I'll just have to get out of the trade, right? But this is a nice position to be in because, it certainly has a nice profit. I've already taken off half. Now I'm just kind of sitting there taking profits if it gives them to me, and I'll just continue to do that. But this has been a nice trade, locked in a gain of 4.19% on Coca-Cola. TLT. Okay, little different trade here. Abandoned baby trade. So abandoned baby sounds like a horrible situation, right? But abandoned baby happens when this pattern happens. This is the abandoned baby day. This is this bar here with the green block around it. The day before the abandoned baby day, we gapped down. Can you see this? So from the previous close, it opened down. So the sentiment of bonds was very bearish, right? From overnight, it opened up down. Everything was bearish. Well, the very next day, it gaps up. This is what forms the abandoned baby. If you gap down, but the very next day you gap up, something important has happened. You've had a major shift in sentiment from bearish to bullish in a very short amount of time. When this happens, it helps you see the future a little bit, not perfectly. But when this happens and you're at a key level like low 30 RSIs, you're down near the negative third ATR channels, more times than not in the future, the price will be higher. When you have a sudden shift from bearish to bullish, a lot is going on under the hood. So this is why I bought TLT here. Now, could I have bought it on the day as soon as it formed the baby? Remember, gap down, gap up. When that happens, I know it's a baby. I could have, but when a baby forms, I just know that the major support level of that baby is the high of the baby, which is this line here, 87.59. So I didn't buy it on that particular day. And sometimes I don't buy these and they just get away from me, and that's fine. But what I like to do is I like to wait for the price to come back down and basically get close or touch the high of that baby. That's why I bought it. I bought it here, 87.73. Now, the majority of my trades, I'm scaling out. I'm taking partial profits. I have an emergency stop. I have an end of bar stop, right? Whenever I have an abandoned baby, I make it very simple. So I entered here 87.73. This is a one or another trade. This is a set it and forget it trade. So as soon as I enter long, I position size and place my 2 ATR stop below, right? And if it gets down here, how much have I lost in my account? 1%, right? But I know that in the future, when these abandoned babies happen, more times than not in the future, I'm going to be higher. So I place my profit target at 4 ATRs. So my stop loss is 2 ATRs. My profit target is 4 ATRs. So I have the ability to make twice as much as I'm willing to lose. Okay, and I know percentage-wise, more times than not, it will be higher. So this is called asymmetrical risk. When you stand to gain, in this particular case, I stand to gain twice as much as what I'm willing to lose. And so this is it. I place my 2 ATR stop below, I place my 4 ATR profit target above, and I just set it and forget it. Eventually, pretty confident, it's either going to get here to my profit target or it's going to get to my stop loss. For sure it is. One way or the other it is, right? But I just know that the odds are in my favor on this trade, and it's more likely I'm going to hit my 4 ATR profit target than my 2 ATR stop. All right. And so right off the bat, it went against me, and then we had this nice rally up, and now we've pulled back. So where we are on this particular trade is up, not a lot, 0.09% on TLT with the abandoned baby strategy. AMD, okay, this has been a really nice trade. We have an order block. Where's the order? Why the order block? We have a swing low, we have a swing high, we have a lower swing low. We change market structure here by taking out the swing high. It defines the order block, lowest closing bar prior to market structure change. The high and the low of this bar is the smart money area. Bring it into the future. Well, came down here. That's where it bounced. I didn't buy it there, but here I bought it on the 12th of January. Why? Two reasons. It rejected the high of the order block. You can see during the day it was in the order block. It closed above it. But also it rejected the 100-day moving average. And remember, if I have moving averages inside the order blocks, I can use that as my line in the sand. And that's exactly what I did. So rejected two key areas, rejected the high of the order block and rejected the 100-day moving average. So I got in 207.77. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 100-day moving average, or this red line. See how close I am to it anyway? Next day, if it had just closed 1 penny under, I just get out. That's it. You know, I want to give my, if I'm wrong on the trade, I want to be wrong quickly, and I want it to be close to my entry point. Place my 1.5 ATR stop above, and fortunately this trade really went my way. Next day took off like a rocket ship, multiple profit targets into the strength, and I got to trailing stop level in the very next day. Next day goes up a little, not enough for a profit target. Next day up again, multiple profit targets into that day. And you can see it got really high and then reversed. So I did get some near the high. Now, this particular day on Thursday, when it was at the high, it was at 65. It's at 62.35 right now, but it did get to 65. So if it's at 65, the 5 EMA comes into play. This is the little thin blue line here. So this trade is kind of on autopilot now. If in the future it closes below the 5 EMA, I am simply out of the trade. That's it. That's done. If it goes up and up to the 70 RSI, rejects 70 RSI, what do? I sell half the position. After that, in the future, if I have a close below previous bar's low, I'm simply out of the trade. So as long as it stays above this 5 EMA, I'm going to stay in. I'll take partial profits. If it goes higher and rejects the 70, then I'll have to take some action and get out too. Okay, so yep, a lot of rules, but every rule that I use, there's really a purpose for this. And the remaining shares I have on AMD up 10.35%. And again, why? Rejection of a major level inside a major level. Rejection of the high of the order block and a rejection of the moving average that lived inside the order block. So key level within key level, and that's worked out really well. So up 10.35% on AMD. Okay, VIX. I did enter VIX on Thursday. Why? Order block related. Okay, let's take a look at the order block first. Here we have a swing low. Here we have a swing high. Here we have another swing low that's lower than the first swing low. And then this day here on the 13th, it took out the swing high, right? Swing low, swing high, lower swing low. This took out the swing high. So essentially, what is that doing? That's changing market structure from bearish to bullish. I don't buy the breakouts, but I buy the pullbacks after the breakout. Then we had the big day up, and now we've pulled back into the order block. Now, this is a little concerning for me for the market. We changed market structure to the upside on the VIX. We've had a pullback. If we have if this pullback here turns into a rally on the VIX, then the market will be going down. Not for sure that's going to happen, but I've seen this multiple times. When you change market structure on the VIX, and the VIX goes way up and the market goes way down, usually the market tends to rally on that first dip. But if that dip doesn't hold, then it can continue down and VIX can continue up. So I bought VIX here on the 15th at 26.29. But Greg, there's no moving average inside the order block. It didn't reject the high, it didn't reject the low. There's no moving averages. Why did you buy it? Well, let's take a look at this bar here, the 13th. Whenever you have a large up bar that's larger than 1 ATR, that's a long, large, strong up bar, if you look at the high and the low and you look at the midpoint, that midpoint is going to provide some inherent support, inherent 50% Fibonacci support. So I know that, and so I drew my own key level inside the order block. And look what happened. On Thursday, we came down, we went under my key level of 26.10, we closed back above it. Okay, that's my entry. That's why I took the trade at 26.29. I position sized correctly. I, of course, placed my emergency stop 2 ATRs below, but my end of bar stop on this particular trade is simply a close below 26.10. You can see on Friday, earlier we went under it, but we closed above it, so it kept me in the trade. So I'm not in trailing stop mode yet, but I am above my end of bar stop. This trade's up a little, not a lot. It's up about 0.5%, but kind of bigger picture here, when VIX changes market structure to the upside and then pulls back into the order block, now I'm a little concerned about the market in general. And so I'm glad that I have VIX here, as it's a little bit of a hedge against some of my other longs. So watch this, If we break back below this order block, okay, then the market probably rallies. But if the longer the VIX stays in here or goes up, the more likely the market is to pull back. So this trades up 0.49% in one day based upon the rejection of the midpoint line of the large bar inside the order block, key level within key level. All right, INDA. I did take a trade on INDA on Friday. Why? This one's pretty easy. Rejection of the bottom of the order block. Okay, so let's look back here. Swing low, swing high, lower swing low, market structure change. It defines the order block, the lowest closing bar prior to market structure change. Bring that into the future. Now, after that market structure change happened and we're way up here looking back down to here, was that smart money? Well, it certainly was at this point. Now I bring that smart money area into the future. Is it smart money this time? We'll see. We shall see. But why did I enter the trade? Because we rejected the bottom of the order block. At one point on Friday, we were significantly below the order block, weren't we? But we closed back in it. Okay, that's the signal. It's not a key level within a key level. This is just one key level, a rejection of the bottom of the order block. So I entered at 52.84. Place my emergency stop 2 ATRs below. My end of bar stop is so close. If we simply close below the low of the order block, and the low of the order block is 52.80, looks like, which is 5 cents below me. If we close at 52.79, I'll just be out, right? Good risk to reward ratio, rejected a key level. If I'm wrong, hopefully I'll be wrong quickly and I'll be wrong small. But if I'm right, then I have a lot of upside on the trade. So I'm essentially break even on this trade. Just took it on Friday, but this is a good example of a rejection of the bottom of the order block. Remember, we can reject the high of the order block, we can reject a key level inside the order block like this 250, or we can reject the bottom of the order block, which what happened. So do I know what's going to happen with INDA? I do not. Do I know what I'm going to do with this trade? Absolutely. If it closes below the low of this order block, I am simply out quickly, done, that's it. I have my emergency stop 2 ATRs down here in the worst case scenario. And again, if it gets down here, how much do I lose? 1% of my account. Is it likely to get there? No. 5% of the time. 95% of the time, if I do have a loss, the other 95% will just be if it closes below the low of the order block. So if it does close below the order block, hopefully it's not too far below, so it can be a very small loss. But of course, ideally, I'd like it to go up, right? So good example there. That one's completely break even. So those are all the open positions that I have. Pretty good, pretty good. Now I do have 6 positions that I closed this week. Some of them profitable, some of them not profitable, but not all trades are profitable. But what you'll see is that the trades that I'm profitable on, I'm in for quite a long time. The trades that I'm not profitable on, I've tried, I got in, it didn't work, I get out quickly. So let's look at the trades that I closed out last week that closed below my stops or got me out for whatever reason. Okay, so this is Netflix, and I'll tell you, I've taken quite a few trades on Netflix. I have not been able to get any of them to work. And that's just how it goes. But let's take a look at the trade. Let's take a look at the thinking of why I entered. So I entered Netflix here on the 13th of January at $90.30. Okay, I have a key level inside here, which is the $90 level. I'll show you that in a minute. The previous day before I took the trade, it was under and it closed back above. I'm like, great, I'll take the trade. So I entered at 90.30. I placed my emergency stop 2 ATRs below. I placed my 1.5 a trailing stop 1.5 ATRs above, and my stop was simply a close below the $90 level. And you can see the very next day it closed below. So what did I have to do? I had to get out. But I wanted to show you why I picked the $90 level. And this even though it didn't work, this $90 level goes all the way back. You can find it 100 years ago to here on April 9th. Oh, somebody's at the door. Hang on. Okay, sorry about that. Somebody was at the door there. Now where was I? Oh, why I picked the $90 level all the way back to 49.25. It's this big up bar. Remember what I told you? If you have a big up bar, that midpoint is an important level of support. So I brought that $90 level from way back 4.9 all the way into the future because they do have support. More times than not, they will key off of that. And so that's why I got in, because the previous day was under 90, then we closed over 90. I got in at $90.30. My stop was simply a close below that 90, and it did close below that 90. So I took a loss on this particular trade of 2.01%. But it's a good example of everyone of getting into the trade. How long was I in the trade? 1 day, right? I was in the trade 1 day. If it had gone up, would I be in the trade 1 day? No. I would have stayed in there and had the process to keep me in there, because if you're in the money, like if you're profitable on the trade, what does it show you? It shows you that the market agrees with you, and more likely it's going to go higher than lower. But I had my trigger, I had my signal, key level within key level, just didn't work. This time it didn't work. So I took a loss of 2.01%. Now, in the future, can I use that as a different level to get in? Yeah, of course. If I close back over 90, can I get in? Sure, and use that 90 again. We do have earnings coming up here next week, so clearly we're going to go above it or we're going to go below it. But at the moment, I am out because we closed below and for a loss of 2.01%. Campbell Soup, another example of having a signal, it not working, and getting out quickly. Here I got into Campbell's on the 9th of December at 26.43. Why? Well, clearly we're in an order block. That's one reason. And clearly, not clearly, but I know during the day we went under the 30 RSI and then we closed back above it. So key level within key level, right? Deep dip buy, the under 30 over 30 is the deep dip buy within the key level of the order block. We went under 30, over 30. I got in 26.43, key level within key level. Emergency stop 2 ATRs below, 1.5 ATRs above. Next day it held. The next day, what happened? It closed below the 30 RSI. What do? My signal tells me to get out of the trade, which I did. I lost 1.26%. But this particular trade, I was in 2 days. So when they don't work, I get out quick. When they work, I can be in them for weeks. Like some other trades I'll show you here. But this is fine. It's going to happen to all traders. But again, be very impatient with your losers. Be very patient with your winners. Here, I am very impatient and got out in 2 days, lost 1.26%. Microsoft. Okay, let's go to Microsoft. We had an order block from the past. I got in here on 11/21/25. Why? Rejection of the bottom of the order block. I got in 472.10. Place my emergency stop 2 ATRs below. Place my 1.5 trailing stop level 1.5 ATRs above. My end of bar stop, simply a close below this order block. The next day, during the day, yeah, it was below, but it closed back in, kept me in the trade. Next day, again, went under the order block, closed in the order block, kept me in the trade. The next day, up, profit target, thankfully. Next day, up, profit target, thankfully, right? I'm tightening up my stop every time I hit a profit target. And I got to trailing stop level. Next day, down a little bit. Next day, up, profit target into that strength. And then here, on the 3rd of December, we have our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of my position for a gain of 1.33%. Next day up, profit target. Next day up. Next day up strongly, multiple profit targets. Into that strength, I took them. Next day up a little, but no profit targets. Then down. Then up, profit target, great. Then down, 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 never close below the order block. Up, this day here, sold into the strength, which you'll see is ultimately, I was very glad that happened. And then we moved sideways. Really, nothing happened. We came down, but we were strong enough to continue to close above the low of the order block, kept me in the trade. Then we had a big up day here. I took multiple profit targets into that strength, and then down, down, and look what happened here on the 13th. This closed below the low of the order block. What do? I got out of the trade. The remaining shares, I had a loss of 0.35%. But does that mean I lost money on the trade? No, I made money on the trade. Now let's take a look at it of why that happened, big picture. And we'll kind of point out the advantages of taking the partial profits. Look how many profits I took into the strength here, into the strength here, into the strength here, into the strength here. And again, I got out of half of everything here. So all in all, yeah, I made money on this trade. The remaining part of this trade, I lost 0.35, hardly anything. But the key point here is I got out when it lost the order block. Was that the right time to get out? Yeah, look, clearly it was. So the remaining shares on that lost 0.35%. FXY. All right, well, this was an odyssey. I got into FXY here on the 20th of November at 58.33. Why? Rejection to the bottom of the order block. Place my 1.5 trailing stop level above, place my 2 ATR emergency stop below. Next day took off like a rocket ship. Again, you'll see the advantages of taking the partial profits. Hit multiple profit targets into that strength. Then down, up, profit target. And then here on the 26th, we have our first close below a previous bar's low after reaching trailing stop level. What do? I took off half of the remaining shares for a gain of 0.78%. Then we move up, definitely profit targets into that strength. Then we move down, we move up again strongly, profit targets into that strength. Then we move down pretty significantly. And then we have another rallies up here. I'm taking partial profits into that. And then we collapse down here. But we never close below the low of the order block, keeps me in the trade. Then we have 3 days up here where I'm selling into the strength at profitable levels. Then we move down, we have one profit target here, and then here on the 12th, we finally close below the low of the order block. What do I have to do? I have to get out. The remaining shares that I had getting out, I had a loss of 0.41%. But all in all, did I make money on the trade? Again, I made money on the trade because of the partial profits, because of going into trailing stop mode and getting rid of half here. Right? So I hope this shows you the importance and the advantages of taking the partial profits when the market gives them to you. But the remaining shares, yes, I lost 0.41%. UNH was a really good trade. I got into UNH here on the 22nd of December. Why? Key level within an order block. Let's look at the order block. Swing low, swing high, lower swing low, market structure change. Defines the order block, comes back into the order block. Now, remember what I told you about strong up bars. If I have a strong up bar, that halfway point is going to be a key level. That was 324. I put the 324 key level inside the order block. And on this particular day, on the 22nd, we went below that key level, closed above it. I got in 324.90. Okay, I position size. I place my emergency stop 2 ATRs below. I place my trailing stop level 1.5 ATRs above. Where's my end of bar stop? A close below this 324 level. Okay. Next day, touched it, closed above. Next day, touched it, closed above. Next day, up, profit target, sideways. Next day, up, profit target, move back down. Next day, multiple profit targets into the strength. I also got your trailing stop level. Next day, up again. selling multiple profit targets into that strength. Okay. Next day, up again, multiple profit targets into that strength. We are now at this point at a 65 RSI level, so the 5 EMA comes into play. The next day, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half for a gain of 5.12%. Next day up, sold into that strength, a profit target. And then ultimately here on the 12th, I got out of everything. I got out of the remainder for a gain of 4.63%. And why? It closed below the 5 EMA after getting to the 65 RSI level. So I am completely out of the trade, locked in that remaining shares for 4.63%. And was that the right move? Yeah, clearly it was, because we're much lower than that now. So this is a good example of getting in an order block, key level, the midpoint of the large up bar inside the key level of the order block, riding it up, selling partial profits into that strength, getting to the 65 RSI level, 5 EMA comes into play, and then when it finally lost that, I got out, and that was the right thing to do in this case. So remaining shares up 4.63%. Last but not least, on the daily open, or the daily closed is oil. Oil has been another Odyssey trade for sure. Okay, I got into oil, USO, back here on the 20th of October at $67.81. Why? Take a look at the chart. Why do you think I got in? Rejection of the high of the order block. Pretty simple. Not a key level within a key level, just one key level. Rejection of the higher the order block. I got in at 67.81. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block at 63, but 63 is a lot closer than 64.80. Place my 1.5 trailing stop level here. Next day takes off. I sell into that strength. Great. Multiple profit targets. Next day, up strongly. Multiple profit targets into the strength. Also at trailing stop level. Next day takes off again. Multiple profit targets into that strength. Then we go sideways, and then here on the 28th is our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the remaining shares that I have for a gain of 4.97%. And I'm not going to go through all these bars, but essentially we kind of move sideways here. We move down. You can see the bars that I did take profits on. I took a profit target there, then we moved down. I took a profit target here. I took a profit target here. Anytime I had a strong move up, I took a little off. And again, taking a little off locks it in, reduces your position size, and by reducing your position size, just by default, you are tightening up your stop more and more and more because you have fewer shares. Then we move down and then up, again, taking profit targets into the strength, and then all the way down here, all the way down, down, down. Look right here on the 16th. Do I get out? No, because it closed. It went below the low of the order block, but it closed above. It kept me in just by a little bit. And again, continued to move up, took partial profits whenever I had the big moves up, sideways down, and then for about 5 days, strong up, profit target, profit target, profit target, the 14th, profit target. Here we got to the 65 RSI level. So if I get to the 65 RSI level and I lose the 5 EMA after that, what do? I get out of the trade. And that's exactly what I did here on Thursday when it closed below the 5 EMA after getting to a 65 RSI level. I exited the trade, and the remaining shares I exited the trade was a gain of 4.64%. So I am out of that. So I did close out 1, 2, 3, 4, 5, 6 trades that I have, 6 positions that I had. So I had a lot of trades. That's why these podcasts have been so long. But luckily, these are gone. I won't have to talk about them anymore. So you can see, not all profitable, but the ones that were profitable, they're a lot more profitable than the losses. And the key point that I want to mention is that the ones that are profitable, I stayed in. The ones that were not profitable, I got out, and I got out pretty dang quick. And that's the way you should do it. Remember, patient with your winners, impatient with your losers. So those are the daily opens that we have here. I just went over the daily positions that I closed out. And let's do one more on the weekly charts. I also trade on the weekly time frame. I haven't had a lot of trades lately on the weekly time frame, but let me show you the one that I'm currently in, and that's UUP. That is the dollar. I got in all the way back on 7/11/25, back in July. It better be positive if I'm in the trade for that long, right? And it is. So I got in UUP here at 26.31. Why? Key level, key level. Of course, we have the order block here. We closed above the order block. Check. Now, look at the black line. The black line is the weekly 200-week moving average. The previous week we closed below, then we closed above. Two primary signals. Close under, close over the 200. Also rejected the high of the order block. I got in at 26.31. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200 week. Place my trailing stop level here. Next week we go up. Profit target. Great. Next week we come down. Next week we go up strongly. I hit multiple profit targets into that strength, and I hit trailing stop level. Next week down, next week down. We have our first close below a previous bar's low after reaching trailing stop level. What do? I locked in again on half the position of 0.49%. Then for 4 weeks, we moved sideways, really nothing. Then this was a key week here because we were underneath the 200 during the week. If it closed under there, I would have had to have gotten out, but yet it rallied at the end of the week, closed back above, kept me in the trade, thankfully, because then the next week we move up, profit targets into that move. Next week, nothing. Next week, up again, multiple profit targets into that weekly move. Couple weeks sideways, another pretty nice move up where I took profits into that move. Couple weeks sideways, another big bar up, profits into that, partial profits. Now we've moved down. We moved down for about a month, and then we caught a bid here. The week before, I had a profit target. This week up, not enough for a profit target, but the remaining shares that I have on this particular weekly trade on the dollar up 4.05%. Pretty nice. So that's a big percentage move on the currency. So look, we're at 59.77. If the dollar continues to rally and we get to 65, then the 5 EMA will come into play. But that's the only weekly trade I have. Remaining shares on that up 4.05%. Okay, so I hope that was helpful for you to take a look at the trades, why I entered, how I'm managing the trade. And now, before we start taking a look at the potential setups for next week, I just want to do a few minutes on trader psychology. This is from my friend Steve Burns. Steve is a very famous trader, author. Check out all of his books on Amazon.com. Any book by Steve Burns is great. You'll learn a lot. Follow Steve over at S. Joseph Burns over on Twitter or over on X, whatever they're calling it these days. This is a simple post, but it is so important. Really it is. And let's read it. There is nothing to fear with the single trade when you position size right. Pretty simple. There is nothing to fear with the single trade when you position size right. So listen, if you know what your maximum allowed loss is on any one trade, and you're okay with it, that's the key. You have to be okay with it. Like sometimes, I teach stock trading lessons. I have students all over the world. And when we talk about position sizing, I use 1%, right? 1% of my account divided by the value of 2 ATR. But some people use 2%, some people use 3%. And people say, "Oh yeah, I'm totally fine with a 5,000 maximum dollar loss." I'm like, "Are you? Are you really?" You have to be really honest and truthful with yourself, and you have to look into the future and think to yourself, what about if I have 5 positions? And what about if all 5 positions hit their maximum allowed loss and each one's 5,000, and that's a $25,000 potential down day? Are you really okay with that? Right? You have to be completely honest with yourself about really what your maximum allowed loss is. And you can figure it out and go, you know what? Really? If I have a $500 loss, I guess I'm okay with that. I'd be pissed, but I'm okay with it. All right. That's the key starting point. Because if you honestly and truly are okay with a $500 maximum size loss and you position size that, then all's good in the world. The worst case scenario is that something's going to happen to you that you are okay with. Now, majority of time it's not going to happen. So that's a plus. But if it does happen, you have to be okay with it. So there is nothing to fear with the single trade when your position size is right. That is true. But make sure when you say I'm okay with $1,000 loss that you really are. Because if you're not and it happens, then you're not going to be in this real comfortable psychological place on your trade. But if you really are okay with $1,000 loss, then nothing can go wrong other than you lose $1,000, which you are supposedly okay with anyway. So, take some time, think about that. Think about really honestly what your think about honestly what a maximum allowed loss is that you are really, truly okay with. And if that happens, then everything's fine with your trading and you don't have to fear anything because you don't have to fear the maximum allowed loss if you're really okay with it. Position sizing and your losses are the most important part of trading, in my opinion, by far. If you position size too large and you have a big loss, it can affect you emotionally, right? You can go into a downward spiral for sure. So it's important to use the right uh, dollar size that you are okay with. And if you use too large of a position size, you may not follow your process correctly either. I just, in my trading and with my students trading, I want them to always be in the right state of mind psychologically where they are following their process. Remember, following the process to the T is the most important part. If you do it with good trading principles, you're going to be just fine. You're going to make money. But it all starts with that first maximum allowed loss amount. You have to be okay. So there's nothing to fear with the single trade when your position size is right. That is absolutely true. But you really have to dial in on your maximum allowed loss and then do your position size from that. So thank you very much, Steve. Appreciate that. Hope that was helpful. And follow Steve at @SJosephBurns over on Twitter. All right, let's take a look at what I am looking at next week. So here I have 13 potential candidates for the upcoming week. Now, I mention this each week, but I have 13 candidates. Is it possible on Tuesday that all 13 of these might trigger? Yeah, for sure. Unlikely, but it's possible. So does that mean if all 13 of them triggered, I take all 13? Absolutely not. I have a hard and fast rule, everybody, that has served me well over 30 years. I only take one trade per day, regardless of how many entries there are, because one entry is always going to be better than the rest. And so how do I decide? Well, I give each setup a report card. Like for instance, if it has one signal, I get a score of 1. If it has 2 signals, I give it a score of 3. If it has 3 signals, I give it or 1, 2, and 3. You know what I mean, right? So if I have three that trigger, and one has a score of 1, one has a score of 2, one has a score of 3, which one do you think I'm going to pick? I'm going to pick the third one, right? That has a better score, right? Now, you also have to factor in risk to reward. Maybe the one that has a score of 3 doesn't have a good risk to reward. Okay, then I may have to change my mind on that and subtract some points because the risk to reward's not good. So I look at multiple signals. I look at multiple different time frames. If I'm trading the weekly, I might look at the weekly to see if I'm trading the daily. I might look at the weekly to see if the weekly gives me some clarity or some adds to some points on the weekly. I look at relative strength. Maybe the market's down in general, but this particular stock is up. If it's stronger than the market, it gets an extra point. If it's weaker than the market, take a point away, right? So this is really important on how to score these. But again, taking one trade per day, taking the best one, because remember, the best one stacks the odds in my favor. And this is how I trade. This is how I teach my students. And by the way, like I said, I do teach a 20-hour one-on-one course. I have students all over the world. I've taught students from absolute beginners all the way up to the hedge fund level and everywhere in between. And it's a total of 20 hours. It's one-on-one. It's just you and I. I teach you all the different strategies that I use. I teach you step by step exactly how to do it, exactly the rules. We do a lot of simulation trading, which I think is really important because I want to see you trade. I want to see you making the decisions and telling me what to do so that I really know. It's very important for me that when my students are finished with me in the 20-hour course, they have a skill. They know what they're doing. And so if you'd like to be my student, love to have you as a student. I love to teach. I love to watch my students succeed. All you have to do is email me. My email is in the link of the YouTube, and just say, hey, Greg, maybe interested in your one-on-one course. I'll just reply and say, hey, that's great. Let's do a video call and just kind of get to know each other and meet each other. It's not a sales call, I promise you that. I just want to know more about you, your trading challenges, your goals, and it's a good time for you to ask me any questions about the course. And then after that, like I said, it's not a sales call. So after that, you'll have to get back to me if you want to start and do the course. But I know you're going to be happy with it. I know you're going to have a skill you can use the rest of your life. And I have seen so many of my students around the world succeed, and it really makes me happy and like to have you as one of them. So the one-on-one course is $2,000 for 20 hours, worth every penny. I know it's a substantial financial investment, but I have an alternative too, which I have a really good online course available at udemy.com called the Deep Dip Buy Stock Trading Strategy. I've sold so many of those around the world. I think I have like 4.85 out of 5 stars on that course. It's really affordable. It's between $30 and $50. And if you're interested in that, the link is also in the description for that as well. It's 9.5 hours of video. It's very comprehensive. So anyway, there's the business side of the podcast today. But if I can help you, teach you, please reach out to me. I'd be really glad to help you. So let's get started on the setups for next week. So let's start with Apple. I haven't talked about Apple for a while, but Apple is interesting in the fact that we have a order block all the way back here on the 1010 of 2025. The high and the low of this order block bring it into the future. Okay, is there a level inside of here? Well, it's a pretty tall order block, which I don't really like. So I really have to find a level. Now, we're already at 25 RSI level, so the 30 RSI is not down here, it's up here. But here on the 17th of October, we have a large up bar, and the halfway of that large up bar I've brought into the future. So that would be an interesting level for me if we reject the 249.90, basically $250 level, which would make sense psychologically. It's kind of a round number as well. So going into next week, about the only thing I'm interested in on Apple would be a rejection of 249.90. And if it did, I would potentially take the trade. My stop would just simply be a close back below it. Now, we do have earnings coming up. Earnings kind of complicate things. I don't hold through earnings. So, you know, if it comes down and gets in, I may only be in this trade for 2 or 3 or 4 days, if it even triggers. But sometimes you'll get these run-ups into earnings. But so I don't think there's a good chance I'll get into Apple, but if it does come down and reject that 249.90 level, yeah, I would consider taking the trade as long as it holds above 249.90. But if that happens and I'm in, I would have to get out before earnings on the 29th. Okay, so I'm looking for a rejection of 249.90 inside the order block. Berkshire Hathaway, okay, So we have an order block from the past. So I'm looking at key levels within the order block. Now, there is a 300-day moving average here at the order block, but it's above it. And I guess this is just experience, everybody. I don't think I'm really interested in taking that. What I'm interested in taking that, and I don't know if it's going to get there, but if it does get there, it's going to have to get my attention. But this would get my attention right here, 482.20, which is essentially a rejection of the bottom of the order block. So why am I so enamored with this level? Well, because of here. If we go over here to the 4th of November, do you see the big up bar? What did I tell you about big up bars? Halfway of big up bars are important, and that halfway just happens to dovetail with the bottom of this order block. So this kind of makes it easy, right? Just look at this and say, okay, that is my level. 482.20. If I reject 482.20 next week, I'm rejecting halfway that big up bar that I just showed you, and I'm rejecting the bottom of the order block. And then I would just use the 482.20 as my line in the sand or my end of bar stop. So it could certainly get there for sure. And, I don't know for sure, but I would imagine that it would have some kind of reaction there since that's such a key level. So rejection of 482.20. I would consider taking the trade if it rejects that, and then if it closes back under 482.20, I would just go ahead and get out. Carnival, all right. Don't know if this one's going to get here or not, but we have an order block here. Okay. A tall order block. The high of that order block is 26.87. The low is 24.60. Move the order block into the future. Again, if you go up here and you look back in hindsight, was smart money buying here? Well, yeah, clearly it was. Now we're kind of getting back to that getting close again to that smart money area. But what I like about Carnival CCL is that we have 3 key levels that I can key off of. Key level within a key level. The order block itself is a key level, but look, we have the 200-day moving average, the black line. We have the 250-day moving average, the purple line. We have the 300-day moving average, the orange line. These are all 3 key levels. Maybe we go down and we reject the high of we reject the 200-day moving average side of the order block. Yeah, I certainly would consider taking that. My stop would just be a close under the 200. Maybe it goes down below the 200 and rejects the 250. Can I key off of that? Sure. If it closes below, I have to get out. Or maybe it goes down and rejects the 300-day moving average, the orange line. Could I use that? Sure. The 200, the 250, the 300, these are all deep dip buy levels within an order block. So these are all key levels. If it just crashes down and rejects the bottom of the order block, I could also certainly enter with a rejection of the bottom of the order block. But a rejection of the 200, which is 26.83 is legit. Rejection of the 250, which is 26.87 is legit. And a rejection of the 300-day moving average is 25.99 is legit. And the low of the order block, which is 24.60, would also be legit. But maybe it doesn't even get there. I mean, it's pretty far away anyway, right? But it could, and if it does, I'll consider it. Salesforce. Good golly. This is nuts, right? Man. But look, we had an order block back here at 11.20.25, and then we just took off from there. Again, when you're up here and you look back here, was smart money buying there? Well, sure, clearly they were. Are we back to where the smart money was buying? Yeah, we really are. Pretty scary, really. But look, I don't have any major moving averages inside here. We are at a 27.89. So if we close back over the 30 RSI, that would be potential because that would happen inside the order block. So that is one potential. And the other potential would be a rejection of the low of the order block. And the low of the order block's at 222.94. So either a close back over the 30 RSI would be legit. 30 RSI would be your line in the sand, or a rejection of the low of the order block at 222.94. And if it rejected that and I took it, then my stop would be a close back below 222.94. So, yep, looks scary, but we are getting back into that kind of important smart money area. DoorDash, okay, we have an order block. Clearly, you can see there are no moving averages inside the order block or no key midpoint levels inside the order block. So about the only potential on DoorDash would be an under 30 over 30 RSI. Right now we're at 34.77, so it's certainly possible next week that we could go down under the 30 RSI and then close back over the 30 RSI, which would be a legit entry. It's key level under 30 over 30 inside the order block. I would then use the 30 RSI level as my line in the sand, and if it closed back under it, I would have to get out. So that's what I'm looking for on DoorDash. IBB, interesting. We have an order block here. Again, why the order block? Swing low, swing high, lower swing low, market structure change, defines the order block, lowest closing bar before market structure change, bring it into the future. What do you think I'm looking at here? I am looking at the two potential levels here. One of them's not perfect, but it's here at 169.30. Why this one? Because see the big up bar here, halfway. Now the only takeaway here though, it's not in the order block. But if we went below into the order block and then closed back above it, then it would be a rejection of the high of the order block and a rejection of that key level at 169.30. So that's one potential, rejection of 69.30. The other potential would be a rejection of this 50-day moving average. You can see the gray line, right? Which is 168.69. So if we continue to go down, reject that 50 and then close back above the 50, then that's a key level within a key level. Key level order block, key level rejection of the 50. I would use the rejection of the 50 as my stop. So two potentials, rejection of 169.30, halfway of this big up bar on the 6th. End of bar stop would be 169.30, or a rejection of the 50-day moving average, 168.69. If it rejects that in the order block, I could take that trade with and then close below 168.69 as the stop. MasterCard, MA. Okay, a lot of things coming into order blocks here for sure. We have an order block all the way back here from 11.18. MasterCard just skyrocketed. Again, when you're up here and you look back here, was that smart money? Yeah, it was. Are we coming back into the smart money area? Yeah, we are. Does it mean it's smart money this time? No, it does not. But the chances are greater that it will be smart money than it won't. So there are no key moving averages. There are no key levels in this other than an under 30 over 30. We're at 34.37. So next week, if we go under 30 and close over 30, that would be a potential trade. Key level within key level. If it did go under 30 and over 30, then my stop would simply be a close back under 30. McDonald's, MCD. Okay, you have an order block here. You can see swing low, swing high, lower swing low, market structure change, came all the way back down. Where did it stop and rally? In the order block. Didn't take this trade. Some of my students did. Looks like they're doing pretty well. But there's some key levels inside this order block if we continue down. We have the 200-day moving average at 303.47. That would be legitimate. We have the 250-day moving average inside the order block, 302 even. That would be legitimate as well. Of course, kind of goes without saying, rejection of the bottom of the order block, the bottom of the order block is 299.59, and you can see last time it got under the order block, there were no more sellers. It closed back in. So looking for the 200, the 250, or a rejection of the bottom of the order block. Meta. Okay, Meta is kind of interesting here for multiple reasons. You remember I was talking about abandoned babies? Look back here. Was this an abandoned baby in the gray? It was. We gapped down. Very next day, we gap up. Sudden shift in sentiment from bearish to bullish very quickly would indicate in the future that we would go higher. Was it right? 100% it was right. Okay. In addition to that, we have an order block. Okay. Remember what I told you about abandoned babies? The high of the abandoned baby is support. That's why I drew the line here at 590, 530. It's the high of the abandoned baby. Well, the high of the abandoned baby is inside the order block, key level within key level. Now, if we zoom out on Meta from a trend line perspective, look at this swing low here to this swing low. Connect those trend lines up into the future. If you get to that trend line, there will probably be some inherent support. Well, look, the inherent support of that trend line dovetails perfectly nicely with what? The high of the order block. It's an important level. So next week, if we go down and reject the high of the order block, by default, we will have rejected that long-term trend line. That would be a decent entry. My stop would just be a close below that trend line. Alternatively, if it goes down and closes below that 595 level, which is the top of the baby, is also a key level. And of course, the bottom of the order block would be a key level, and the bottom of the order block is 582.87. Now, Meta has earnings coming up on the 28th, so this causes potential issue. So yes, I could have one of these signals trigger rejection of that, the high of the order block in that trend line. That would be legit. Rejection of the middle point, the 590, 530 would be legit. The rejection of the bottom there at 582.87 would be legit. But I may not be able to, even if I get in, and I'm not saying I won't get in, I may get in, but I may not be in the trade very long because regardless, I'm going to have to get out before earnings. Whether I'm in the money, out of the money, even doesn't matter. I don't want to hold through earnings, but that is kind of an interesting key level that long-term trend line is dovetailing to the penny to the high of the order block, and the high of the order block is 606.23. So we certainly may have some downside potential on this, but there are some key levels. That trend line, the midpoint bar, the high of the abandoned baby, and then the low of the order block. So that's what I'm looking at for Meta. But again, if any of these trigger, I may get in, but I may not be able to be in the trade longer than 3-4 days, which is fine. Microsoft, okay, I talked about Microsoft. I had to get out with the close below the low the order block, but there is an order block here. As a matter of fact, one of my students, Vivek in Canada, pointed this out to me. I didn't catch it, but it's all the way back here from 523 going into the future. And it's not a very tall order block, which I like. And this order block here is right here. The high is 542.19. The low is 446.89. So a rejection of the high of this order block or the rejection of the low of this order block would be a legitimate entry for me. But again, we have earnings on the 28th, so that kind of complicates things. I'll just have to play it by ear. I could get a legitimate entry prior to that, but again, I would have to get out. Even if I got in, I would have to get out. Maybe I'm only in the trade 1 or 2 days, but that's fine. I've done that many, many times, and sometimes you get those runs into earnings, but we'll see what happens. But yeah, the high of that order block 452.47 roughly, and the low 446.61 would be a potential. Netflix, well, I talked about Netflix. I had to get out of Netflix. We do have earnings coming up on the 20th, so that's coming up pretty soon. But there's 2 levels here that I'm keying off of. The low of the order block 85.20 or a close back above that $90 level would also be key. After earnings, I'm sure one of those 2 things are going to happen. It's either going to go up above that 90 or it's going to go down significantly, close below the low of the order block, or reject it. So I'm not really looking at getting into Meta until after earnings. But after earnings, if we close back above 90 and it's a good risk to reward ratio, I would consider it. Or if it goes down on earnings, maybe goes way down and then comes back up and recovers and closes back above the low of the order block, 85.30, 85.34, I could also key on them. Yeah, earnings always complicate things. Palantir, PLTR. This one's pretty simple. Nice, clean, easy order block, 200-day moving average inside the order block. About as simple as you can get. One of my favorite trades, 200-day moving average or major moving average, deep dip buy moving average inside an order block. So I don't know if this is going to get there, but if it does and rejects the 200, great. It's a key level within a key level. It's a good risk to reward ratio. I would certainly consider taking the trade. The 200's at 155.44. Last but not least, everybody, is XLU. Same thing. We have a new order block that formed. We have a 200-day moving average inside the order block, and that level is 42.22. If we come down, reject that level, I could key off of that level. That 200-day moving average would be my line in the sand. So anyway, that is what I have for you today, everybody. I hope it was helpful. If it was, please take a second, hit the thumbs up button, share the video, subscribe to the video. Those would all be great. I would really appreciate those. But I hope you have a good rest of your weekend. I hope you have a good trading week next week. We have a shortened trading week because we have MLK Day on Monday. So enjoy the day off. If you have any comments or questions about anything, please put them in the comment section. I'll do my best to get back to you. If I can help you with your trading, I'd love to have you as a student. I also do consultations with hedge funds and other advanced traders. So anything that you have in need of, just contact me. I can help you in many different ways. So I always like to leave off with, please try to go out and do something nice for somebody every day. If we did something nice every day for another person, really, it would make the world a better place. And looking at the world, I think we could use that. I'm also a big animal lover. If you could go out and or try to do one nice thing for an animal when you ever have the opportunity, they appreciate it just like we do. So thank you so much, everyone, for being here. Again, if you have comments, questions, let me know. If I can help you with anything, let me know. But I hope you found this valuable today, and God willing, I will see you next week. Thanks so much, everyone. Take care. Enjoy the rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.